Our next panel here at the MicroCap Investing Workshop. This panel is titled The Canadian MicroCap Investing Strategies. This is sponsored by Leishman, LeBlanc, Catling & Associates at Canaccord Genuity. And our moderator for today's panel is this guy behind me. All right. Thank you.
Thank you, Bobby. My name is Michael LeBlanc. My partner, Harold Leishman, who's not here today, has 25 years in the microcap markets, actually third generation of small cap investing in the Canadian markets. Many of you may have met him before, and you will meet him again, as he unfortunately couldn't be here today. Well, I am joined today, though, with our Canadian partner, David Matusik. A lot of you might have met last night. If we didn't meet you last night, I'm looking forward to meeting you all over the next few days. My background on the team is portfolio management, so try to stay awake through my presentation. But we are going to be talking about our process around microcaps tomorrow, so I'm not going to get a lot into it to bore you today. Today is about the companies that we have here that we want to kind of bring to light some opportunities that we've seen through our process. And our process is really finding those hidden gems in the microcap market, looking for companies that are breaking out. And a big part of that breakout has to do with the management team in our process in finding that quality. And we have two of those companies here today. And just by way of full disclosure, myself and my team do own both these companies. So just to let you know. So join me in welcoming Cameron Watt, President and CEO of InTouch Insight. And he plays a fundamental role in the overall vision and strategy of the company, bringing over 30 years of experience. They include in Pepsi, Unilever, and Yum Brands. Cameron joined InTouch in 2011 and holds a bachelor degree in commerce from University of Alberta and an MBA from Richard Ivey Business School. And Jeffrey Hasham, the CEO of Redishred. He's also been there since 2011. And has been in the shred and information management business for 17 years, and has senior leadership roles in both PROSHRED and Redishred. Jeff also served as VP of Finance of Two Men on a Truck, and CEO of Mini Tanker USA, which is now called Refuel. Jeff is essentially majored in money education with a commerce degree from U of T, University of Toronto, and an MBA from McMaster University in Hamilton, my alma mater. And he also is a CPA and chartered accountant. But let's start things off. I'm going to ask both gentlemen to kind of give us a brief coverage of their companies and what they do. And why don't we start off with Jeff?
Good afternoon, everyone. So our company is in the Shredit business. Well, that's the founding business and probably the bulk of our revenue at the moment. Essentially, we bring big trucks with big shredders to our customers' doors, and we shred on site. When we leave the door, the paper is shred, and we go to the next client. So you can see the logistics and the routing components of that business. We've started to evolve, and we're now in the e-waste and digital scanning, imaging, and data storage business. Those are in their infancy, however, high growth. And the business has been very robust the last 5 years. We made it through COVID, and we'll talk, I'm sure, a little bit about that. We're happy to be in the shred business, scan business, and e-waste business.
Thank you. And Cameron?
InTouch Insight is at its core a data capture and analytics company. We work with location-based businesses primarily to help them deliver on their brand promise. So, how do we do that? Obviously, the big question. We do services through mystery shopping, site audits, various feet on the street that do things. And we also have SaaS-based software with customer satisfaction surveys, forms and automation checklists, and we have an overall customer experience management platform. We work with lots of customers you've heard of, like Wawa and Orange Theory Fitness and General Motors and Arby's, and if you're Canada, people like Petro-Canada and Sobeys. So you've heard of most of our clients, and our job is to give them the information on how their individual locations in particular are performing against their own operational and brand standards and what their customer experience is, so that they can drive improvements to that, which ultimately lifts their stickiness and their customer loyalty and their revenues. So that's kind of, we play in the services and software space around that.
Perfect. Now let's set the stage a little bit for where we're at. Looking at both your stock charts, which we spend too much time doing, there are similar trends with the periods of strength and some longer flat narrowed trading bands over the years. Let's leave out the obvious more recent success in a couple in your names, but if you could talk shortly, maybe we start with Jeff, excluding the pandemic, because we want to get into that a little bit more. What are the major challenges and frustrations you face in 11 years?
It's interesting because probably like a lot of non-mining tech stocks or companies or stories, we really struggled to get what we were doing out there. Once we started to execute on our business plan, and really the business plan very simply is to grow organically, grow through M&A, and people didn't take notice. And I think part of that challenge was when you're not of a certain size, you're tightly held, which we were. It was very difficult to get people to take notice of what we do. Having said that, you have to stay at it, and that's what we did. We continued to speak to the markets. We fortunately bumped into a couple institutional investors on our own that said, wait a minute, this is an interesting business. This is a recurring revenue business. You've got compounding elements from a revenue perspective. You've got compounding elements from a route density perspective. You've got compounding elements from an M&A perspective. And so it took a little bit of good fortune and persistence to get out there. But that is the challenge. It's how do you get that story out there? We're very fortunate now that we have research coverage, and that's a game changer. I think for any diversified industry, non-tech, non-mining issuer, that's an important thing to get your business model and the strengths of your business model in the hands of a couple of the investment dealers, and if you can get some research coverage, that's huge, and that's what we did. It was just really one foot in front of the other, and really getting the story out there. We'll talk maybe a little bit later about reporting, but the financial reporting was something that we also honed in on and said, how do we make it easy for the user to understand our story? And we came back, I guess, being an accountant, it was easy, but it was also hard because you need to be able to tell the story in a very non-accountant way to the marketplace. So that was for us. Those are things that we looked at and did, but it was very much a struggle. And even to this very day, I don't think people fully understand our story, which means we haven't gotten the job done.
Thank you, Cameron. You've also been at the helm there for 11 years. How are the many challenges that you guys met and you guys overcame?
Ignoring pandemic, obviously.
Yeah.
So I'm going to take a little different tactic than Jeff did. He talked about market challenges. I'll talk a little about business challenges. Maybe you can understand our business a little better that way. I bucketed into two main challenges, I'd say, over the last, for me, probably 9 years, and that would be culture and go-to-market strategies. When I actually joined I took over as CEO in 2013, and a year after, about 10 months after I took over, I found myself trying to figure out why I was so completely ineffective at my job. It was, nothing I was trying to have the company do seemed to be working. It didn't seem to be moving forward. And so I had to figure out what was going on. And it turned out that at that time we didn't have any SaaS products. That one was a purely service-based industry company. And it turned out that the operations team, run by a VP of operations at the time, was listening and nodding, but she was ignoring at the same time, and that she had a command and control structure. She had built hierarchies. We had silos in the organization, which I use as a word for a negative hierarchy. And people were not doing the things that they're asked to do, and they were scared to tell me that they weren't doing them because they were scared to get fired by the person below me that was telling them to do something different. And so I found that we had just an acidic culture inside that company which I didn't see in my previous role because I was up in sales and marketing out on the road, And so I cleaned out the executive team effectively. The only person left was my CFO after we finished up. We rebuilt from the top down, and we rebuilt with culture in mind. I hired an HR guy to be my operations person. Wasn't very good at HR. I wasn't very good at operations for a bit. But I'll tell you, real great at turning the culture on, then we put him into the right role later. And once we got that culture fixed, I'll tell you, that solved a lot of future problems. And that is still the thing that from a challenge standpoint, we focus as we grow to maintain that culture. We now have, 3 times the employees we had then, and we have to maintain that culture. And that's one big challenge. And the other one we faced is a go-to-market challenge always. We have services and software that go to market. We're competing with companies worth like billions of dollars who have marketing budgets that are, ridiculously beyond anything I can dream of at this point, right? So we compete on that side, and then the other side we compete with some smaller mom and pops, and we compete in industries where it's not even done by RFP, it's done by word of mouth and by a lot of handshakes. So we have a very broad spectrum. And so we're always trying to figure out what the right go-to-market strategy is. Where do we tip the balance between investing in marketing versus investing in a salesperson? And then what type of salesperson? Do we focus on the services and then we cross-sell the software? Do we get the net new software first and then cross-sell services? So there's a lot, we have so much opportunity with some really great products that we are constantly trying to find, the best way to get the most growth. Sometimes we've got it right, sometimes we've got it wrong. We just keep pushing the ball up the hill, but those are big challenges for us.
Perfect. Well, let's deal with the elephant in the financials. The pandemic had obviously different effects on a lot of companies around the world. And given that you're both in different sectors, Cameron, why don't we stick with you? Why don't we give us a little bit of how InTouch was impacted during the economic shutdown?
Well, I already told you that we focus on location-based businesses, and I named a bunch of them. So unlike Shopify that seemed to get a really nice blue sky situation out of it, we hit a brick wall. Right, so when our customers closed their doors, we hit a brick wall. I'm very proud of how we handle it. Before the pandemic, I was telling investors that hey, we're a low risk company with upside as we bootstrap a software company, and most of them nodded and went, yeah, sure. Everyone says they're low risk. We went through the pandemic serving the industries that closed their doors for 2 years, and we remained EBITDA positive for the entire time. And we came out of it with our key personnel and all of our key customers. We didn't lose one contract during that time. Now, we had lots of them stop for months and years, but we didn't lose any of them. They all came back. And so, it was brutal. I mean, it was just brutal, to be honest with you. We did pay cuts, we did furloughs, you name the survival tactic, and we had to do it. But we did it well. We came out of it well. We maintained everything we needed to in the business to now be launching forward with it. I call it the 2-year pause, and I'm real happy with where we're at. But it was brutal.
And Jeff, your business is also managing a kind of quasi-traditional and technology-driven kind of solution moving forward. What effect did you see through the economic closures?
Yeah, well, we really tested ourselves. Winston Churchill said, never waste a good crisis, and very true. My largest shareholder, just as the pandemic was starting, said, I guess we'll see how resilient and resistant this business really is. And I think a couple things that were fortunate. Number one, like your business, Cameron, my entire team was with us. We all took pay cuts willingly. We all did what we needed to do. And what I said to them is when we cross the bridge to the other side post-pandemic, they'll be rewarded with ownership. And so again, coming back to the people was critical that we had the team. The type of customer we had, small, medium-sized enterprise, essential services. So in the United States, where all of our servicing is April and May, we were down 40%, and then in 2020, and then boom, it took off like a rocket in June. Comparatively, we were only down 10%, and for the rest of the year, we're down 15 to 20%. We're well above pre-pandemic levels now. So what do I mean, don't waste a good crisis? The thing that we needed to know during the crisis was everything. daily sales, routing margins, how are the routes being put together, and you can't do that when you've got multiple locations across the United States. So we had to deploy good people putting in good technology. So we actually hired technology people during that time. We actually deployed a new workflow software, deployed Microsoft Power BI to get dashboards. And so right now I can look at my screen and know pretty much everything. From the safety performance of a driver to the route performance to the daily revenue. So we needed to know that to monitor the business. Like Cameron, our business was EBITDA positive through the whole time. The team did a great job, and when we started to recover, we turned the pay cuts into pay deferrals and paid them all back and gave them all stock. And we're one of the lucky ones, I got to say.
Excellent. So obviously maintaining growth in a venture market can be impeded by the challenges of access to capital. You both have taken advantage of acquisitions in recent history as an opportunity for growth for your companies using very different approaches. Cameron, can you speak to how InTouch has dealt with this in the past and where you see things in the future?
Sure. I mean, our acquisition or M&A strategy is pretty simple. We have a very tight float. We've only got about 25 million shares outstanding, and that is after we also put out about 1 million shares to employees at the end of the pandemic. After looking after employees, after looking after some acquisitions where we did use a little bit of equity for the owner, we're still 25 million shares. So with a tight float like that, we're very, very careful that we don't go and raise money. Our strategy is not to go to the public markets and do a raise to go do an acquisition. We're very stingy, well, for lack of a better way to put it, with our shares. And so we have always looked for opportunities where they're accretive. So we want to find opportunities where the revenue stream and the income coming off it virtually can pay for itself out of its own cash flow in terms of its ongoing needs. And we have been very successful in doing that. We have been using bank debt at fair rates. We've been using a little bit of stock sometimes for an owner if we want to keep them engaged. And we've used our own cash that we've accumulated to make our acquisitions. And once so how do we get those? How do you find them? Well, a lot of owners, they might want to sell, but they're really picky with who they sell to sometimes. And so we look for opportunities where we get a really good deal because we've been a reputation in the industry as a really good acquirer. That we don't come in and strip mine it. We don't come in and, just get rid of everything and everybody, and it's like the Borg, coming in. We have a reputation of coming in. We keep the office for extended periods of time. If there's an office, we keep the key employees engaged. We look after them. If anything, they benefit from the larger company coming in. And so a lot of owners, certainly historically, have cared about how their business is treated after they leave, because a lot of them, for them, it's their child. And so our strategy is to be a really nice, friendly acquirer, get really good deals, and to be able to do it at a rate that's accretive and beneficial to our existing shareholders. And so far, that's worked pretty well.
Excellent. And Jeff, you've completed a successful financing just at the end of 2021 there. Maybe you can speak to your strategy and what you see looking forward.
It's interesting. Being a good buyer has its benefits in building good relationships with those folks that are looking to sell. That's always been our strategy. If you sort of look out in the shredding and scanning space, there's well over 750 players. Most of them are independents. Most of them are mom and pops. Most of them have 2 trucks or less. So having a relationship with them and being there for them when they need to be there is important. And so, like Cameron, we want to do acquisitions. We want to do them smart. We went 2.5 years without raising equity, including the 6 months pause because of COVID. We've done almost $66 million in deals since 2018, but we haven't raised anywhere near that amount. So again, how did we do it? Cash flow, earnouts, and of course the bank. The banks were giving money out at very, very low interest. I mean, in the historical context of it, they still do. So we're able to go out and do acquisitions. So that raise that we did at the end of the year, we did it right on the back of a very large acquisition that was fully bank financed. And so our strategy is very simple. We have 16 franchisees that are very large. They're hubs. We want to buy them. We want to keep all their employees, and then we want to go out and buy 5% of the 750 independents and tuck them in. And that's our very simple acquisition strategy. More importantly, whatever we would buy, we want to grow, because that's the only way to keep as many of those people employed that we've taken on. Is you've got to grow it. And so putting our teams together and our engines together on the sales and marketing side is very critical. So our strategy is very, very simple. Buy it smart, and then grow it the right way. And fortunately, we've had good success with that.
Excellent. So that kind of sets the stage for how we got to where we are today. Let's talk a little bit about inflection points, because they're really important when we're talking about future growth and of course the stock price. If you're looking at your business going forward and into the future, we'll stick with you, Jeff. Where do you see the key opportunities for that moving forward? And you mentioned just earlier, leveraging the foundation that you've already built.
Yeah, I think it's key that in our business, I mean, just to give everyone context, we target small, medium-sized enterprise. Our average shredding customer is $100 a month. So if you think about what's in our database, 250,000 customers, and the majority, we've got many, many recurring clients, 50% plus of our revenue is recurring in nature. So how do we now build off of that? How do we go to those clients and market to them other services, whether they're compliance services, e-waste services? We're very well equipped to do that. Now what we're adding is this scanning, imaging, and digital access to people's documents. So creating this sort of cradle to grave idea around information management. Small, medium-sized enterprises are late adopters pretty much of everything. So the nice thing is we're going to them with a very unique solution where they don't have to think about it. They can create the document, they can digitize it, they can store it, they can shred it. The elephant in the room for us has always been, well, what happens when paper goes away? Stored paper is going to go away, but people are still going to use paper. So having a service in place is sort of where we start. And then adding these incremental services to all these clients that make sense. So we're not adding crazy services. That's the opportunity. And these are now, again, I talk about compounders. These are all these compounders that we get to utilize our existing facilities, our existing teams. It gives people growth opportunities, career opportunities. That's the nice thing about what we're doing in our space. So yeah, we've been very happy about where we're going and what we're adding to the mix.
Cameron, you're also in the position to provide strategic growth for your clients and drivers. Now, I don't know if you want to talk on last week's announcement, because that was kind of what we were getting into. You got announced it a week earlier than we thought. And I don't know how much you can get into it.
Well, I mean, what he's alluding to, as you haven't followed it, is we announced a new $7 million contract that we just signed. It's just taking our fundamental capabilities and, from a service standpoint, and saying that we're not a mystery shopping company, we're not an auditing company, we're not a customer satisfaction survey company. We're a data capture company, and we have a lot of core capabilities that we're looking to see how do we leverage these. And so that's just an example of finding a way to leverage a core capability. We have another customer that is doing something similar. I can't name them for NDA reasons, but they're a really big global company, and they have a search engine you've heard of. And we go and do a bunch of capture physically for people who advertise with them to make sure that their footprint is correct and accurate on maps and things like that. And we do that all over North America. So this new contract is kind of in that vein. We use LiDAR technology to go and map the virtual world. To map the real world and make it so they can turn it into a virtual world. And it's something that we have the capability to do. We know how to get people everywhere, across North America at once, doing a lot of things. And that's, a lot of revenue for 5 months. We'll see where it goes from there. But we're turning our attention to not only what can we do to expand in all of our existing lines, which we'll continue to do, but how do we also take advantage of our core capabilities and what else that can deliver us in terms of new opportunities.
One of the challenges of delivering a growth and balance between managing business is kind of keeping your team focused. Maybe I know Jeff, you already kind of touched on this a little bit. Maybe you can talk a little bit about how that work-day balance between that and keeping everyone driving forward.
Yeah, like most smaller cap companies, talent is critical. I always go, you've got the investment banks where they keep talent because they pay them a lot of money, but maybe the environment isn't always the greatest. And then you got the opposite where people might work for the Vatican for free. You got to find that happy balance. You got to have a great team. They've got to be fairly compensated. For us, being a public company, we start with the vision. In fact, actually last week, we brought a number of our field management team into Toronto, and normally we do senior management strategy sessions and we don't include them. And I said, no, these folks are on the front lines. They have something completely unique to add. They're coming in. So we worked on their locations, and then we brought that into the larger strategy. So for us, it's keeping everyone in the know about the vision and then working backwards from there. Everyone knows where we want to be in 5 years. And when everyone knows where we as a company want to be in 5 years, I ask them to map out their own verse. So if anyone has seen Dead Poet Society, look for that little snippet. It's about creating your own verse, and for us, we're very sincere in that. I didn't start as CEO. I was promoted, and many of our great talent have been promoted and have been able to write their own verse in the company, knowing the vision and knowing where we're going. So then you layer onto that some technology, and then of course some new services that we're offering, and all of a sudden this becomes an exciting place to work. And yes, people work sometimes long hours. I'm not a big fan of that. I like to have good balance. Obviously there are moments when a deadline's there and they do, but then you balance it out, and we try to be very mindful of that. That if someone's worked a lot, okay, how do we get them out of the office, back home, on a vacation, doing something different? Because I think that's how you keep talent, is keeping that balance and knowing that they're giving to the company, and as a company we must give back to them, and I think we have, because we've had very good retention throughout this pandemic and even during recent times.
Excellent. And then Cameron, dealing with institutional investors is challenging for growth firms, but also kind of your day-to-day shareholders. How do you find the balance, kind of managing the fundamentals of the business, your stretch targets, generating market awareness to reach out to those investors, and what's kind of your ideal investor book look like?
Lots of questions in there. And we're short on time. Let's do a rapid fire. My ideal investor is one who isn't coming into the story because they want to triple their money in 6 months and they're mad if we don't strike gold, right? Because we're not looking for gold. My ideal investor is somebody who goes, you know what, this is a good company. This is an undervalued company because the core of the company is actually, they're not chasing their stock price. They're building value in the company, and I know they're going to get it. And it's only a matter of time before they get it. So I want to get in before we get all the way up there. And somebody who's willing to be patient, and know that that's where the goal is, as opposed to it's not a quick money turnaround. That's not what we do. We're like I said, we're low risk. There's huge upside, but it's not going to happen in 3 months. I hope, but I'm not expecting it to. Right? I'm expecting that things will take a little while for us to get where we want to go. We've got solid plans. So that's kind of the investor. And yeah, balancing that, the balancing act of how much time do you spend here, right? Versus how much time do I spend going to find another $7 million contract? It's tricky. It really is. We don't have an IR firm that we work with. I don't have an IR budget per se. We spend a little bit of money, but we don't do that. We don't go and raise capital. We don't go and do tours on the street. Most of you have never seen me before. And so, is that good? I don't know. It's at the time it probably is, because right now I'm fundamentally focused on building the underlying value in the company, because I know if the value is there, that you can get to that value. I'm more concerned about bouncing it the other way too much up front to where I'm chasing something that people think is going to be there and it's not yet, and I got to chase it now. So that balance is tough. Right now, we're probably, especially since the pandemic hit, we've definitely tipped towards operational focus as opposed to investor relations focus. I think we need to start, as we get the growth story going, as we get fundamentals back on track, which is very firmly underway right now. I think we will have to look, not in the not too distant future, towards swinging that pendulum a bit. But I think that for now, we're probably off balance towards running the company versus the IR and finding investors. But I think it's where we need to be right now, and then we can swing that pendulum as we need to.
Jeff, if you could just touch briefly on the same kind of question as far as kind of the promotion and dealing with shareholders, how you guys are handling that.
It's interesting because we've always said put your head down on the business and build the business. We've probably been more active the last few years with the street. I think part of it is when you got research coverage, and the reality for us is that we have come to the markets since 2018 3 times for equity raises. Folks need to know the story. They need to hear from management the plans. Of course, our goal has always been, hey, this is our plan. This is where we're going. We are not looking for investors that are looking for the short-term win. We've made the mistake of being attracted to that before, and that hurts, because when they decide that they're not patient enough for your story, they drop the stock and boom. So some wounds from lessons from those lessons. We've learned a lot, but yeah, it's a combination. Keep your head down, work on the business, utilize talk to the markets, keep them informed. That's been our strategy, and it's worked. I prefer to be working on the business, but I recognize that we need our shareholders and new shareholders in order to help us drive some value.
All right. So I've taken up all the time asking questions, but we have a couple of minutes. If any of you have any direct questions, keep it in mind. We'll all three be around over the next couple of days to answer your questions more socially.
First question is, you work in a pretty competitive space, so how do you differentiate yourself from your offerings? And the second one is, can you pick one of your closest competitors whom you admire, and why do you admire them? And I'll sneak in one more, Jeff, for you. You're trying to buy in all your franchisees and stuff like that. Why do you want to move from a less capital intensive model to a more capital intensive model? So, sorry, I sneaked in a bonus one there, but.
You've got 3.
I've got.
If there's 3 things, I need a list.
Yeah, that was quite the list. I'll go really quickly. Our competitors, Iron Mountain, Shredit, are the big ones. There's 750 independents out there. Iron Mountain be the one that I think I have the most respect for. They play nicely in the market. They've got a nice bundling of services and the like. The third question, why are we buying our franchisees? I think it really comes down to the economics of franchising in our business. Our business is not one that cash flows quickly. You start at zero and you work your way up, and we can work our way up to some nice numbers, but franchising for us is a money-losing game. We got to support our franchisees. When a franchisee's new, we take 6.5% of nothing. And then when they're big and they're doing $2, $3, $4, $5 million, we take 5% of $2, $3, $4, $5 million. Where for us, owning them and deploying that capital allows us 2 things. Number one, 35% direct EBITDA margin, so that's very good use of capital because the margins are so good, and the opportunity to buy those little independents and tuck them in. That there's some real accretion. Small is very beautiful. Doesn't move the needle on its own, but it moves the needle in the long term if you can do enough of them. So that's why we've taken that strategy and it's working. So good question.
Very quickly. Our key competitors are very different depending whether you're talking software or whether you're talking services. On the software side, you've heard of them, Qualtrics, Medallia, Clarabridge, etc. On the services side, you haven't heard of them. People like Market Force, Bear International, all 360. You know, obviously the software competitors are very strong. I mean, Qualtrics has they came from nowhere as an upstart, and they really did a great job of taking that market away from people like Medallia. In terms of how we differentiate ourselves, which I think was the first question, we can do things for our location-based industries. We're very focused and targeted on that. I'm probably not going to beat Medallia on a giant call center for Coca-Cola. But when it comes to location-based industries, all of my software, all my analytics, all my tooling, all my triggers, alerts, things that help them improve their business is built for that industry. And I can do it cheaper than they can. And because I can also combine it with the services, right? I can bundle those things together. And when I'm up against a services competitor, none of them, there are no other public companies in the services space that I compete in. I'm one of the largest, as small as I am, we're at a MicroCap conference, I'm here, but I'm a giant in the services space in terms of some of the stuff that we do in North America. I mean, it's a fragmented industry, keep in mind, lots of room there, but I'm relatively large. And I'm the only one that has my own development team. And I'm the only one that builds my own software. I'm the only one that has my own technology. Everybody else is using a third party or some 20-year-old technology. So I can deliver things in a way, in a time period that nobody else can touch on that side of the business.
Blackson, I think that's our time. I want to thank everyone for joining us. I want to thank both Cameron and Jeff. And as I mentioned, please do ask your questions to them later on today. I'll be around. Looking forward to meeting you all, and see you tonight.